Once you get all of your information into these input sheets, it's going to be time to look at your financials, make sure they make sense, make sure they look reasonable, and I'm going to show you a little bit of what that might look like. Again, this is going to vary wildly on the stage that you're at and what industry you're in and what your product or service is, but hopefully these numbers will be at least something to kind of give you an idea. So I've gone ahead and put my own numbers in here, not what was in the previous videos, so I filled in different numbers just to give you an idea. The first statement we'll look at is the one that they're calling the assets, liabilities, and stockholders' equity, which is again also called the balance sheet. So this is your balance sheet. And the first thing you're going to want to make sure is that you've got positive cash balances here. If it's negative, that just means there's two areas you need to address. So if it's negative, it means you might have just entered a whole bunch of expenses. And how you can get that cash number up, I apologize, there's actually kind of three things. So how you can get that cash number up is the money right here is the capital contributions from the owners. So if you and your partners or whoever the owners are contributing cash, this is where it would go. So here in this example, I've got two partners. Those are the two owners, and they've each contributed 5,000. You know, they bought 5,000 shares for a par value of 1, which is $10,000. So the system, this spreadsheet, is working out that they've contributed $10,000 cash. So if you are contributing money, if that's an actual thing, don't put it there if it's not true, but if you are contributing cash or if you've contributed to the expenses of the company, you can put that here as an owner contribution and it will increase the cash number. Another way to increase cash is if you come down here, the debt instruments. So if you're taking a loan or a line of credit or something like that, so here you can see that I've said there's a small business loan and we've drawn $150,000 and we repay $350 a month on that. So it would probably be higher, but it's just as an example. The interest rate it allows you to put, so it calculates how much interest you pay during the year. And again, this is going to contribute to your cash balance. So again, if you're actually going to take a debt instrument, if you're taking out a loan or a line of credit, something like that, or a note, a convertible note, that could go here, and that's going to increase your cash. And the other way is just making sure your sales are correct. So now I've changed these numbers again. You're going to see later if there's different revenue streams. I plugged numbers in here. So the price and the volume, that's basically giving me my revenue numbers. You also want to make sure where it says what percentage of revenues do you expect to collect, make sure that's 100. Again, these are just confusing numbers that we'll probably eventually get rid of. It's just that they're required to work out the financial statements. So make sure that you've got your selling price, your volume, and make sure you've got 100 here listed as the percentage of revenues you're going to collect. So those things will make sure that you've got a positive cash balance. Make sure that these numbers stay positive. Otherwise, it's saying that you ran out of money, which you don't want to do. So part of it is the cash. The other part is your property and equipment, and the numbers that are here are coming from your fixed assets. So those, big expensive things that we put down here are what show up on your property and equipment, and that equals your assets. There are a few other things here. Again, if you understand the numbers enough to work with things like prepaid expenses, go for it, but don't feel like you have to. And that's going to list your asset amount. So after you've gone here and looked at the cash, made sure that's positive, looked at your property and equipment, you've got your total asset number here, you can look at the rest of it, which is liabilities and stockholders' equity, and it will match or balance, hence the term balance sheet. So these numbers are going to be the same. And if they're not, there's something wrong with your spreadsheet and you should get in touch. Down here, so again, liabilities and stockholders' equity, your liabilities are stuff that you owe. So in this case, most of it's going to be the payable, that loan that we took out, the small business loan. So this is the balance of the small business loan. And that's really the only liability that we had. So in this instance, basically, we've got our notes payable, and that equals our total liabilities. The equity part is a little bit more confusing. Don't feel like you need to understand it. In this case, there's common stock, which was the contribution by the owners in the very beginning. So they've got, $10,000 worth of stock. And then there's retained earnings. Now the retained earnings is negative because retained earnings is basically a flow through of your net income. And if you look at the income statement, which we'll get to in a second, in year one, it was negative 119. And that's what shows up on the retained earnings on the year one balance sheet. So that's where that number is coming from. Those should match. And that gives you the total liabilities and stockholders' equity, which again will match your total assets. So that's all the balance sheet is. Make sure that your cash is positive, make sure that your liability, make sure everything really here is positive except for the retained earnings, those can be negative, and make sure that balances. And this is a pretty simple statement, that's all you really need to double check. The next statement you want to look at is what they're calling the statement of revenues and expenses. That's also your income statement or your profit and loss, your P&L. And here you want to first make sure that your sales numbers are correct. So in this case, year one is $225,000, which is exactly what I have kind of plugged in here on my input tab. Because I did not enter this as a quote unquote widget template, there aren't any, inventories. You actually will not probably have inventory if you're not messing with those inventory percentages. But if you don't have a product or a widget that you're signing, direct materials and labor to, you might not have anything here, and that's fine. It's basically just going to give you your gross profit as your sales number, which again is fine. The operating expenses, it's not going to break out until the next sheet, so it's just going to show you one solid number, and then your operating income or loss. Now, these numbers are for your first couple of years, unless you've been in business for a number of years already. So an operating loss is completely normal. Obviously, it can't be outrageous, and you still need to watch your cash numbers over here, that you have enough cash and that, you're not borrowing millions of dollars. But a loss is going to happen, and that's fine. In most cases, you hope that the trend is going to be an upwards trend. So my loss is quite large in year one, and it gets smaller in year two, and then maybe year three, I'm going to break even. But we don't ask you to go that far. So a loss in the first couple of years is completely fine. If your numbers look like this, don't worry about it. Just make sure everything else makes sense, and make sure it's cohesive to what you have written in the rest of your business plan. The last statement is the one that the judges are definitely going to take a look at and want to make sure it looks reasonable, which is your statement of operating expenses. Really, this is just a breakdown of the expenses that are here on your income statement or your profit and loss, but it lists them actually by account. So here we see that these are all our year one expenses broke down. Here are all our year two expenses broken down. Every single one of them grows. So as the business grows, your expenses are going to grow. And other than that, like I said, just make sure nothing's negative. It shouldn't allow you to enter negatives, but just make sure nothing's negative. And really, again, this is going to depend heavily on your industry. Look at what other companies are doing as far as percentages. A lot of industries have stuff where they say you probably will be spending X% of your revenues on advertising or on development. Take a look and see if you can find competitors who have published financials, and take a look just to kind of give you somewhat of a benchmark to look at what your expenses will be. Other than that, the judges just want to see that you've taken stuff into consideration. You're going to have insurance expenses. You're going to have to repair stuff. There's going to be repairs. Again, if it's not relevant to you, maybe this company won't ever really be driving anywhere for work purposes, so they don't have an automobile expense. It's going to be very customizable to what you're doing. Just make sure that it's also cohesive and it makes sense, and anything that you've written in your executive summary or in your marketing plans all makes sense and ties back to the financials, and they could be compared to one another and still be reasonable.